money in there to cover those costs. You're really not going to have a problem with the servicing of the loan itself or the ultimate discharge.
Well, thank you for the call. Joanne, I'm coming to you, but yes or no, I told you no yes or no answers, right? Here's a yes or no question. Do I care whether or not the bank sells my loan?
No.
Absolutely no problem.
No.
Okay. Then talk to me for a minute about qualifications. They've changed, obviously, from where we were a couple of years ago.
Somewhat.
What are you looking for?
Somewhat.
Steady income?
Steady income, right. We're looking to make sure that that income is stable, which is hard to predict.
Yeah, in this market,
obviously
sure.
at times, yes. But the same qualifications that have always been there: income, assets, credit.
How important is that? You know, you see these, they advertise, you check your credit score. Does the bank look at that? What is it? Which one? The services out there for your credit score. Is that important?
TRW.
TRW, yeah, whatever.
It's usually a triple credit score.
It's very important to be aware of your credit history, I would say. Credit score, can have an impact on your loan depending on which lender you go to. There's risk-based pricing for some lenders, and for others there's not.
Are you going to reject somebody because they've fallen behind on a credit card payment or something of that nature?
Could.
You could?
Possibly could.
Okay.
It depends.
That's tighter than where we were a couple of years ago, that's for sure.
I don't think we would reject someone on just that basis. So we'd look at the overall picture and the overall credit history.
It's not usually just one thing that is going on. If you're behind in one credit card payment, there are usually other things that are going on.
Yeah.
It depends on how serious it was, how long ago it was, or how recent it was.
Sure. Okay. Joanne from Cooperstown, New York. Are you still with me?
Yes, I am.
Thanks for holding on. Welcome to the show.
My question is, what is the difference between a home equity loan and a home equity line of credit?
I didn't have that in my list of
question.
questions
It's
for you.
it's
Yeah,
really a
that's
good
why
question.
we love the audience. Go ahead, Louise.
A home equity loan is an installment loan. It has a fixed interest rate normally. It's amortized, meaning you're making a principal and interest payment. There's no flexibility. You get the funds when you close on the loan, and then you repay them. A line of credit normally has a variable interest rate. It's flexible. You get a book of checks. You're able to advance from your line of credit over a certain period of time. And generally the payments during that period are interest payments, but you can make principal payments. At the end of the draw period, the period of time in which you can advance from your line of credit, you're generally required to repay the principal over a specific period of time. So two very different products. And the product that you choose would depend, I think, on your personal financial style and also perhaps how you're going to be using the funds.
And obviously, just a caveat to be careful on the home equity. You're pledging your house, so you want to make sure you pay that loan back, correct?
Yes, that's true, yes.
That's not.
It is a mortgage.
Right.
Yeah, they're both mortgages.
There are many instances in which customers come in and say, I don't have a mortgage. Great, fine. But then later on in the conversation, you'll discover that they have a home equity loan.
But I have a home equity loan.
Yes, and people, that's true. People
or
often
a
do
tax
that.
advantage car loan.
Yeah. Joanne, does that help out?
I'm still not sure which way to go then.
What do you need the money for?
That's the question.
Right.
I'm putting an addition on my house, a bedroom on the downstairs.
Are you going to be doing it all at one time? Are you going to be doing it over a period of time?
Putting the addition up?
Yes.
Yeah.
I hope to just have
All
it
at
put
once.
on and that's it.
All at once.
Is your contractor going to be expecting payments over time, or is your contractor going to be expecting one lump sum payment at the end of the construction period?
I imagine something up front, something during, and something at the end.
Okay, well then it's very likely that the line of credit would work for you, assuming that the construction period was a longer period of time. If it's a short construction period, a couple of months, then it really doesn't make a difference. You're not really worried about the interest that's going to be accumulating, and either product probably works for you.
Yeah, I would say either product would work for you. You could do a home equity loan, advance all of the funds, and deposit them, and then just advance them to your builder over time.
Okay. Joanne, I got to move along a little bit, but thank you for the call. I hope that helps out. You folks on this side of the fence, does it help? Is it a benefit if a buyer comes in with a large down payment? That's got to be enticing to the seller?
Is it more attractive to the seller?
Yeah. I would think.
It is to the seller because it means that the person's more committed to the house. And if I want the house so much that I'm going to And say you put an offer in at $5,000 deposit, and Seth put one in at $15,000. The seller's probably, if all other things are equal, they're going to go with Seth. So
but there's a distinction between down payment. I'm sorry.
Down payment and deposit
versus deposit. Right.
Yeah, down payment. It really doesn't make a difference to the seller the amount of down payment. It can state that that person is more financially able to follow through with the transaction.
Yeah.
But the bank's going to figure that out for everybody anyway.
It's more attractive to the bank, certainly, which,
I would think.
Right, which may make it more attractive to the seller.
To the seller,
they know that someone with a larger down payment is more likely to qualify.
And real quick, if someone was having a little trouble qualifying, we just answered the question. Then a big down payment might just put them over the
right.
Okay.
Yeah. The other piece is going back to it's like the myth about being a cash buyer. In today's times where you can finance, and if you have good credit and you have a nice deposit, cash doesn't make a difference in that purchase. Can it make it cleaner? It's a cleaner process, but that doesn't mean you're going to win that contract.
All right, let me
buy that house.
Let me wrap up. Sorry, let me wrap up the whole issue of purchase. Who's the typical buyer here in Central New York now? Age-wise, what are they looking for? Who's the buyer right now?
The average buyer is that Generation Y or Generation X person, and they are not looking for a used house, meaning that it's beat up, that it's got to be taken care of. They do not want to move into their parents' house. They want to move into, they don't own a used car, they've never bought a used washer and dryer. They go through a cell phone every year. And so you're laughing, you're probably like one of your kids. But
they're not getting phones yet.
But the thing is that they want a house that they don't have, they want maybe 95% of the house to be completed, and they can choose the paint color. They don't want to have to go in and gut a kitchen. And so if one house on the same street, and they're looking at two houses, one house has got it all done, and the other house doesn't, and the house that doesn't might be $20,000 less, they're still going to buy the house that's in better condition.
That makes sense. And then, Tom, quick, you made a comment last year on the show that just kind of stuck in my mind, how the Internet is, I mean, quite literally changing how you do business and how real estate gets done.
Right.
Probably that's continuing.
It's actually it's morphing as a word, I guess. It is actually changing the whole dynamics of selling and buying a house. 89% of buyers are going online and looking at a house first.
We'll make that 90%. I've gone online. I mean,
so you're the one. You're that guy.
Well, I'm the one.
You're the guy. All right.
But to see what's out there, because that's what you do.
Well, that's what you're doing. But now with the technology, you have the virtual tours, you have the podcasts. There's so much you can see about a house. The amazing part is for the sellers, they have to shift their mindset because they'll fix the inside of the house, but they won't put the money on the outside of the house and for the curb appeal. So if everybody's online looking for a house and they're looking at pictures and they're going through, you may actually lose a buyer because he doesn't find it attractive.
And your 10 to 15 hours that you mentioned earlier is actually probably 400 hours that the buyer has already spent.
Absolutely.
God knows how long they said.
Right. And they're looking at virtual tours and they're going through.
We're seeing buyers that will spend a month to 2 months on the internet looking at different websites like SyracuseHomeSearcher.com. They're on there creating their own search. Buyers can now go on, create their own search like a real estate agent normally used to. Create the search for themselves and start sifting through different houses.
And that's okay.
Which is great.
That's okay.
That's great.
Right?
Well, plus then you put them on your listserv for that specific qualification relative to the house, and they get kicked out emails for every new listing that meets those criteria.
So what you have now is a much more educated buyer, not just for real estate, but for anything, because everybody's using the real estate.
Yeah. And let me just see, I'm running a little long here. Charlene, are you still there? Charlene?
Yes.
Are you still there? Okay,
Yes.
I'm sorry, we're running late. Go ahead with your question, please.
How close to the assessed value does a house usually sell?
Good question.
I'm a firm believer that the assessment has absolutely nothing to do with the purchase price, and every municipality is very different. Every municipality has been reviewed or updated at different times, and that you really shouldn't be looking at the assessed value. There are many people that I know who are presently well over-assessed, and they haven't been able to make much headway with the grievance officer.
Don't even. We're going to talk about that.
But then